Welcome back, everyone. I'm Severino, your personal business coach. Today, I'm going to share the one addition that I've done to my portfolio, the one stock that I've been buying this week. And we are going to study 6 super investors, people who manage 11 billion under management, 18 billion under management, and 28 billion under management, to find out what their team knows that we don't know. Because they have full teams. They have analysts, researchers, portfolio managers that deploy 40 hours a week studying these things. So we will learn from the best, from the people who have 29% annualized returns on their portfolio, 24%, 15%. What can we learn from them? What did they buy this month? What did they sell this month? And what can we learn from their behavior? So let's jump into it. I personally like to study Chuck Aker, who has an annualized return of 24% on his portfolio, which is beating the market. And he looks at his famous three-legged stool. He looks at a great business that has a great team that strongly reinvests into its growth. And he manages 11 billion asset under management. Bill Ackman has 15% annualized and has recently made some really good bets. He looks at dominance in a specific field plus free cash flow, a company that dominates their field plus has strong free cash flow. Bill manages 11 billion under management and he did 15%. Brett Gerstner has an annualized return of 29% and he specializes on tech, specifically cloud and tech innovation. He has under management 18 billion. Dev Kantesaria, less known scholar of Warren Buffett. His style is very similar. He looks at monopolies, at high barriers to entry. His annualized return is 20%, also very high, and he manages 3 billion. Christopher Hone has 15% annualized. He also looks at monopolies, barriers to entry, and he manages 28 billion. That's the biggest asset under management portfolio that we're going to talk about today. And he also got some awards and some recognition from different institutions this year because he crushed it. And then Mark Messi, with his 12% annualized return, he looks at wide moat businesses. He manages the smallest of the portfolios that we're going to look at with 4.5 billion under management. Let's go. Let's dive into those portfolios so that you guys can see. And by the way, if there is a super investors that you miss here and you would like me to cover next, let me know in the comments and I might get to them in the next video. So let's jump into the first portfolio. The interesting thing about this portfolio is that it's very concentrated. As you can see, we have only 1, 2, 3, 4, 5, 6, 7, 8 positions. So huge portfolio in terms of assets under management and only 8 positions. So when I see things like these, I get excited because we have here somebody with conviction, right? Somebody who has the guts to do what a few people do, to use the luxury of concentration. If you concentrate, of course, the upside is much higher. This is how you build wealth. And many people who manage these large assets under management, they don't dare to do it. So Alterock is really interesting in terms of concentration. The first one that Alterock goes into is TransDigm. I know nothing about them, so I will not speak about them. They produce parts of airplanes. And so I don't know that industry. I cannot give you any alpha. And it's the first time that I see this company. He went in really hard with 27%. Then Microsoft with 17%. Microsoft has been on a tear. He slightly reduced Microsoft by 10%, but that doesn't mean anything. Microsoft was on a tear, so he took profits. That's a normal rebalancing act. His conviction is high. Google, he reduced by 8%. He's strongly in Google. Few of the super investors are so strong in their conviction with Google. Many super investors think that AI is going to take some market shares from Google because search will be done on an AI software instead of in the traditional Google search. Amazon, again, something where a few super investors have such a high allocation, 15% in Amazon. I mean, it's in my portfolio too. Amazon, Google, Visa are the three things that are also in our portfolio, and we are also highly concentrated. But most super investors don't dare to go there in such a high concentration. Many have Visa, a few have Amazon, but the people who have Visa, they are around 2%, 1%, 3%, not 10.6 like Alta Rock. So Visa, 10.6, and we love Visa, we love Amazon, and we're also still in Google. Moody's, 7%. Moody's is also in Warren Buffett's portfolio. Moody's has a high moat because, credit is what our society is built upon. So if there is one thing that will always stay the same is that our global economy is built on debt. And your debt needs to be rated. And there are basically only three companies. Two of them have a duopoly. That's Moody's and S&P Global. And those two have to rate your credit. It makes a difference. If they don't pay for that credit rating, the loan will be much more expensive. They will pay much more for the money that they want to take. So for them, as an example, it's a no-brainer to pay $600,000 to Moody's for a rating that will make their loan cheaper by $2 million. So it's a highly incentive, and it's basically a no-brainer business model. Many governments have tried to stop that duopoly. They didn't. So it's still there. Similar with MasterCard and Visa, who are really a duopoly in the payment networks sector. MasterCard reduced by 4%. That's also just a rebalancing. And Moody's is the only addition here, strong addition, 135% plus for Moody's. Let's move on to the next portfolio. The next one is Chris Hone with TCI. And Chris just got awarded for this portfolio, which is also a very concentrated one, strong. And it's typical for moat-oriented investors to go into a railway. So he has 12% in Canadian Pacific Kansas City and in Canadian National Railway Co. 14%, that's typical, right? He has 15% in General Electric. Again, Moody's here with 13%. 12% in Visa, strong allocation. Microsoft, of course. And here, the second one we were talking about in the duopoly, SPGI, S&P Global. S&P Global has one more characteristic. So I'm also thinking of entering Moody's. And I've been also looking at S&P Global. S&P Global has even one more feature than Moody's has, that it's not just rating credit, but it has also a data component, a data asset. They just bought a data company. They are a data company. They have data that's really important for financial platforms, and they're happy to pay for. So S&P has that credit rating as an asset plus the data business. Google again with 6%, Thermo Fisher, Ferguson, and again, Alphabet, pretty the same. Google and Google L are pretty the same. One of them has a little bit of governance component in it, but it's negligible, such a tiny difference. You don't become really a decider with that little governance. Then we have the next portfolio, Valley Forge Capital here. We have Fair Isaac with 30%. That's a strong allocation to Fair Isaac. We have again S&P Global. You see a pattern here with these moat-oriented investors. MasterCard, Moody's. MasterCard with 18%, strong allocation. Moody's with 13%. Intuit, that's the software behind the bookkeeping and accounting, especially in North America. Things like QuickBooks, etc., are in Intuit. So high margins, recurring revenues, high switching costs, because if you are happy with your accounting system, it's a lot of work and a lot of risk to change the vendor, to change software. So why not staying with them? Visa, 6.7%, Aspen, and ASML holding. ASML and Visa are also strong holdings in our portfolio, as you know. Then we move to Brett Gerstner. Brett, you might know him from his appearances on the All In podcast. Brett focuses on cloud, mainly cloud, and especially the innovation in the tech space. So he is with 44% in Snowflake, which he really strongly believes in. I think it's a great company, but it's not in my portfolio. Meta with 14%. We are in Meta too. Uber, 13%. Microsoft, 10%. 6.5% NVIDIA. NVIDIA is obviously a strong company. We'll see how earnings go. It's not in my portfolio anymore. I think it's overvalued, but it's an amazing company. And then we have CFLT. I don't even know what that is. Pinduoduo, Amazon, Tesla, Mercado Libre, GrabW. I don't know about that. And VLRS also beats me. This is Brett Gerstner's portfolio. It's all tech. And it's pretty strong, I would say. This is a portfolio with a strong thesis. Again, a very, very concentrated portfolio. Bill Ackman, who's been crushing it lately, and he's very active on X. I actually like his postings, except the political ones. He has 18% into Chipotle, which is being on a tear. I was very surprised that restaurants like Chipotle and Texas Roadhouse can be so strong in performance. So the reduction of 13% is just a normal rebalancing. He's in another restaurant brand, QSR. He went into Hilton and Howard Hughes Holdings. He holds Google, Canadian Pacific, Kansas Cities, which does not quite fit this portfolio style, Google, and Lowe's. That's Bill Ackman. And let's see what Chuck Aker is doing. Chuck Aker is famous for his three-legged stool. He's an OG in the space, very known super investor. And the three-legged stool means that he looks at three things: great company, great management, and great rate of reinvesting into the business, which can be buying back shares, and is everything that you put back into the core assets and shareholders. So 18% MasterCard, 15% Moody's. There is a pattern there. American Tower. I am super interested in American Tower, I have to tell you. Those guys, they build literally, we're talking, if you see a 5G tower, for example, that tower literally needs a little piece of land, needs a protection around it, and needs to be built and developed and managed. That's what American Tower does. They also have high dividends, if I remember correctly. So they're on my watch list as a possible second dividend play together with Vici. None of them has Vici, by the way. And you will see why Vici matters in a second. Then we have KKR, O'Reilly, Visa, Roper Technologies, Brookfield, CoStar, Danaher. Danaher's clients are hospitals. And so that's a moat. Hospitals don't change vendor quickly. CarMax, Brookfield Asset Management, Digital Bridge Group, SBA Communication, Goosehead Insurance, Berkshire Hathaway, Dollar Tree, and Verisk Analytics. They've been reducing a lot. Strongest reduction is Visa. That's surprising, 26% reduction in Visa. What do they know that we don't know? I've been adding Visa over the last months. And this is Chuck Aker. Now, the last thing that I wanted to share with you is that I've been buying. And what has Simon been buying this week? I've been buying real property in Las Vegas in the form of VICI, V-I-C-I. Why did I buy that? And how does it fit in my portfolio? So it's the most defensive stock in my portfolio. It's a REIT, so it's a fund. They own parts of the Las Vegas Strip. I will do a full video on VICI soon. But the short thing is they own the most interesting parts of Las Vegas, and it's limited in supply. And as you know, I look at supply first and demand second. So it's limited in supply. Their contracts with their tenants are 42 years long. They have an escalation clause in the contract. I've seen the contract. There is an escalation clause that if CPI increases, so if inflation increases, then they charge more. And they are de-risked because their tenants will pay the increase in CPI immediately. They have a tenants percentage of 100%, so it's always rented out, even in the year 2000. So it's very de-risked. It's currently trading at $29.50. I think it's worth its intrinsic value $36. It will get to $36 this year, probably 2024. That's my expectation. Plus it pays a healthy dividend. So that's why I went into VICI as a defensive part in my portfolio. Hope you have a great week. Let me know what you need next and keep rolling.